What if the retirement money you're counting on isn't all there when you need it, or your insurance company doesn't have enough money to pay all its claims when disaster strikes? That might sound extreme, but pension funds and insurance companies are helping finance the enormous AI investment boom. Hundreds of billions of dollars are being borrowed to build AI data centers, and some of that debt is finding its way into pension and insurance investments. And there's another concern. A recent SEC decision means certain data center debt structures don't have to follow some of the safeguards normally required for asset-backed securities. So if the AI boom goes wrong, does part of the loss eventually land on you? This video is for educational and informational purposes only and does not constitute financial advice. Always do your own research and consider your personal financial circumstances before making investment decisions. Let's start with the scale. According to Reuters, around $220 billion of AI-related corporate debt had already been issued in 2026 by August the 10th. For comparison, the equivalent figure in 2025 was just $12.5 billion. That's a remarkable increase. Why? Because building AI is extraordinarily expensive. Data centers, GPUs, power generation, cooling, networking, land. But whenever somebody borrows money, somebody else has to lend it. Some AI financing comes from banks, some comes from traditional corporate bonds. And increasing amounts of capital are also being provided through private credit and other institutional investors. That can include pension funds and insurance companies. And there is a logical reason why they might want these investments. Pension funds have money today that needs to fund retirement payments years or even decades into the future. Insurance companies collect premiums today, but some claims won't be paid for many years. Long-term investments generating predictable income can therefore be extremely attractive. And we need to make something very clear. There's nothing inherently wrong with a pension fund or insurance company investing in data center debt. Some of the companies involved are among the strongest businesses in the world. The debt may have a strong credit rating. A data center may have a long-term lease. And institutional investors normally diversify their portfolios. So the problem isn't simply that pension funds own some AI-related debt. The more important question is whether many apparently different investments are becoming dependent on the same underlying assumption that AI will generate enough future revenue to justify the extraordinary amount of money being invested today. Imagine a pension fund owns Amazon bonds. It also owns Microsoft debt. It invests in a private credit fund financing data centers. And another part of the portfolio owns technology shares. On paper, those are different investments, different companies, different securities, even different asset classes. But increasingly, some of them may depend upon the same economic story. AI. If AI generates enormous profits, that may not be a problem. But if the industry has overestimated future demand, several supposedly different investments could come under pressure at the same time. That's concentration risk hiding inside diversification. There's another complication. The technology company doesn't always borrow the money itself. A separate company, sometimes called a special purpose vehicle, can finance or own the data center. The technology company signs a long-term lease or agreement to use its computing capacity. Those payments can then provide the cash used to service the debt. The Bank for International Settlements has described arrangements like these as shadow borrowing, obligations that behave economically like debt, but largely sit outside the technology company's balance sheet. And the BIS says these structures are strengthening the links between hyperscalers, private credit vehicles, and insurers. So simply looking at the debt on a technology company's balance sheet may not reveal the whole picture. Then, on July the 29th, SEC staff considered a particular type of data center securitization. They agreed that securities structured in the way described did not meet the legal definition of an asset-backed security under US securities law. But we need to be careful about what that means. It does not mean there are no physical assets involved. The data center itself is obviously an asset. And it doesn't mean the SEC declared these investments unsafe. The issue is their legal classification. Traditional asset-backed securities are generally based around pools of financial assets producing cash flows. Mortgages are a familiar example. A data center is an operating asset. One of the easiest consequences to understand involves something called risk retention. Following the global financial crisis, regulations were introduced requiring sponsors of many asset-backed securitizations to retain at least 5% of the credit risk. In simple terms, keep some skin in the game. Imagine I make a $100 loan. Then I immediately sell the entire loan to somebody else. If that borrower later defaults, whose money have I lost? Not mine. But if I'm required to keep part of that loan myself, I have a stronger incentive to care about its quality. For qualifying data center structures covered by the SEC staff position, that mandatory asset-backed security risk retention requirement doesn't apply. But there's an important qualification. That doesn't mean data center sponsors are suddenly retaining none of the risk. In fact, sponsors of existing data center securitizations have sometimes retained substantially more than 5%. So we shouldn't exaggerate what changed. The important difference is this. Under these qualifying structures, they may choose to retain significant exposure, but that particular asset-backed security requirement doesn't force them to. And risk retention isn't the only difference. There are other rules specifically associated with asset-backed securities. These can cover areas such as conflicts of interest, certain reporting requirements, and disclosure relating to third-party due diligence. For the particular data center structures covered by the SEC interpretation, some of those ABS-specific requirements don't apply. That doesn't mean there are no rules. Other securities laws, contracts, and investor protections still exist. But when hundreds of billions of dollars are potentially involved, understanding exactly which protections apply becomes important. And now consider how much bigger this could become. In August, NVIDIA announced partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The objective is to create financing platforms capable of mobilizing more than $500 billion of third-party capital for AI infrastructure over time. To be clear, that isn't $500 billion of debt already issued. It's intended financing capacity. But NVIDIA describes the initiative as turning AI compute infrastructure into an investable asset class for global capital. Think about what that means. The physical infrastructure behind AI is increasingly becoming something that can be financed, packaged, and distributed through global capital markets. And investors aren't ignoring the risk. As technology companies issue increasing amounts of debt, investors have begun demanding greater returns to absorb it. Reuters reported in August that technology bond spreads had moved above the broader investment grade market. Recent deals have also required greater concessions to attract buyers. That doesn't mean investors believe AI is going to fail. They're saying something much simpler. If you want us to finance more and more of this expansion, we want to be paid more for taking the risk. And eventually, there may be limits to how much debt traditional institutional investors are prepared to absorb. And here's perhaps the most important point in this video. AI doesn't have to fail for some AI investments to lose money. Imagine AI becomes incredibly important. Businesses use it every day. Productivity increases, and AI genuinely changes the world. But perhaps companies built too many data centers. Maybe they expected much higher prices for computing power, or today's incredibly expensive GPUs become obsolete much faster than expected. The technology can succeed, while some of the financial assumptions made during the boom turn out to be wrong. We've seen this principle before. In the 1990s, investors were absolutely right that the internet would transform the world. What many got wrong was how quickly profits would arrive, which companies would ultimately win, and how much those companies were worth. AI could follow the same principle. The technology could succeed spectacularly. But if too much money is borrowed against overly optimistic expectations, some investors can still suffer substantial losses. And once debt is distributed through private credit, bonds, pension funds, and insurance portfolios, those losses aren't necessarily confined to technology shareholders. It's tempting to compare all of this with the global financial crisis, but we shouldn't take that comparison too far. AI data center debt isn't the same as subprime mortgage debt. Many of today's borrowers have exceptionally strong balance sheets, and we don't currently have evidence suggesting that AI debt threatens the global financial system in the way mortgage securitization eventually did. But there is one lesson from 2008 that's still extremely important. Risk doesn't disappear because you move it somewhere else. If a company moves financing into a separate vehicle, that vehicle issues debt, and that debt is purchased by funds, insurers, and other institutional investors. The risk hasn't vanished. Someone still owns it. So let's return to where we started. Could AI debt eventually affect your retirement savings or your insurance company? Yes. But that is very different from saying your pension is about to disappear. We don't currently have reliable public data showing exactly how much AI-related debt ultimately sits inside pension and insurance portfolios. And diversified pension funds own many different investments. A loss in one area doesn't automatically mean a pension fund fails. But we know pension funds and insurers participate in the market financing the AI boom. We know private credit is becoming increasingly involved. And we know the amount of debt being created is growing rapidly. That's why this is something worth watching. But where can you actually watch this? Start with the companies themselves. Go to the investor relations pages for companies such as Microsoft, Amazon, Meta, Alphabet, and Oracle. Look at their quarterly results, balance sheets, and cash flow statements. For US companies, you can also use the SEC's free EDGAR database. Look for new bond issues, increases in debt, lease commitments, and references to data center financing. Financial news sources such as Reuters can help you follow major new bond issues and changes in borrowing costs. And for the bigger picture, particularly private credit and off-balance sheet financing, look at research from the Bank for International Settlements. You don't need to analyze every individual bond. You're looking for the trend. Ask 4 simple questions. Is AI spending continuing to rise? Is debt rising with it? Are investors demanding higher returns to provide that debt? And most importantly, are AI revenues and cash flows growing quickly enough to pay for everything being built? Because eventually all those complicated financing structures come back to something very simple: cash flow. Someone has to generate enough money to pay the bills. AI could genuinely transform the world, but the financial system is also making an enormous bet on how profitable that transformation will become. Technology companies are spending hundreds of billions. Debt markets are helping finance it. Private credit firms are becoming involved. Insurance companies and pension funds are part of the institutional capital market. And new structures can make it increasingly difficult to see where all of the risk ultimately sits. So perhaps the most important question about the AI investment boom isn't, will AI succeed? It's who financed it and who takes the loss if we've spent too much. If you'd like to understand why so much money is being spent on AI in the first place, I'll link my earlier video about the AI investment and debt boom on screen now. If you found this video useful, please like and subscribe. It costs you nothing and really helps the channel survive.